Hi, and welcome to the LPEA LVPA powered webinar on valuations and the new IPEV guidelines. First of all, I wanted to thank the different contributors of today's panel, including the members of the LVPA, which is the Luxembourg Valuation Professionals Association, and the LPA, so the P and VC, as you know, and certainly also our Market Practice and Operations Committee members, like Hint, Lauriane, and Alexis, who are really pushing for that practice in Luxembourg. This is already the second collaboration between our two associations after the consultation of those new IPEV guidelines, which was also then on our side a quite good test of how we could collaborate more in the future. We are very proud of this vibrant group of valuation experts who are now actually located more and more in Luxembourg and who are fostering further strengthening this Luxembourg middle office, which is also, let's say, strategic and crucial for our future here in Luxembourg in order to make that model evolve further. Our panelists today will discuss, as you can imagine, those new IPEV guidelines, the key changes, the different challenges. Data is always so important, not only here for valuations, but certainly also for ESG and SFDR. But you can imagine in the future, it will really take a strong importance. And finally, also how those changes will be implemented in the future. So without further ado, wanted to pass over to Antoine, who is the Vice President of LVPA's board, in order then to kickstart this common panel. Thanks a lot.
Thank you, Stéphane, and good afternoon, everyone. Welcome all to this webinar, so co-organized by the LPEA and the Luxembourg Valuation Professional Association. So the LVPA is a new association officially launched last year in November. Its mission is to lead and represent the valuation professions here in Luxembourg. So you got it. We will talk about private equity on one side, valuation on the other side. So if you put that together, you will immediately come to the International Private Equity Valuation Guidelines, so the IPEV guidelines, the famous one. There was a revised version released on December last year. So we are already 2 months down the road, and we thought that this was probably a good time for already a catch-up where we are on that. And you will see that there are some fair changes to talk about. To talk about it today, I'm really pleased, honored to have also with me for this panel 4 valuation experts from 4 different big firms. And maybe first, Elena. Elena, you're a senior manager in the valuation, modeling, and economics department here at EY Luxembourg. You have over 10 years of experience in valuation across Europe, not only in Luxembourg. You are also a founding committee member of the LVPA, and you regularly give valuation trainings at the House of Trainings. And last but not least, you are also an incoming member of the Business Valuation Board of the International Valuation Standard Council, so IVSC. So first of all, congratulations for this new role, and welcome here.
Thank you, Antoine, and hello, everyone.
Close to you, we have Benjamin. Benjamin, you're a senior manager in the valuation department at Deloitte, Luxembourg. You started your career in the corporate finance department in 2015, and you are a member of the LVPA and at the same time the LPEA Market Practice on Operation Committee, so on both associations. So you are at the right place. Welcome, Benjamin.
Many thanks, and happy to be there today with you.
That's a pleasure. And close to you, we have also Talat. Talat, you're an audit partner at PwC here in Luxembourg, experienced mostly on alternative investments, mainly focusing on US and UK PE and VC asset manager. And you're also one of the leaders of the audit alternative investment valuation teams at PwC Luxembourg. Bonjour, Talat.
Hello, bonjour, Antoine. Very pleased to be with all of you today.
Thank you. And we have also Daniele with us today. So Daniele, you're a corporate finance partner in the deal advisory department at KPMG Luxembourg. You have over 15 years of experience in valuation across different industries, geographies, and you are valuing assets for M&A, financial reporting, and tax purposes. And you're also a funding committee member of the LVPA, which is a great idea. And you're also part of the LPEA Market Practice and Operations Committee. Welcome, Daniele.
Thank you. Thank you for the introduction, and I'm thrilled to be part of this panel to share knowledge together.
I thank you to all of you to be here today for this webinar. Maybe as a quick introduction, so one can obviously see an increasing important place on international accounting authorities and the notion of fair value to reinforce the need for the consistent use of valuation practices worldwide. That's also a key purpose of the revised edition of the IPEV guidelines. So to provide a framework for consistently determining valuation for the type of investments held by private capital funds. So as I mentioned earlier, there was this revised version, so issued in December 2022, so a couple of months ago. The previous one was in December 2018, so almost 4 years between the two editions. And of course, the intention was also to consider what happened during these 4 years. And we can easily think about the pandemic, also about direct consequence, so dislocation on markets, public and private markets. And as well as the significant development of early stage VC companies. And it's also, of course, the case also here in Luxembourg. So the intention today is to focus on these edits, on these changes, the further guidances provided by the IPEV guidelines, and not to comment or to discuss about the overall guidelines. Again, we will focus on the modification that have been made. For the rest, you can obviously get the guidelines. They are publicly available on the website www.privateequityvaluation.com. So what are these changes? So we summarize them, let's say, in 6 categories. So we have first, further guidance on adjustment to EV, and with a focus on early stage, pre-revenues company, so that's 1. 2, the notion of known and knowable information at measurement date. I think it's also a key one, and there was a lot of debate about that around also the pandemic period. 3, ESG, of course, environmental, social, and governance. How to integrate that in valuation models. It's not an easy one. 4, discount on contractual restrictions. And 5, dislocation of markets. Finally, we will also a few words on data quality and robust valuation governance, because of course, to come up to a fair value estimate, you also have to consider the quality of your inputs. So quite a program. We have 60 minutes, so it's really a packed agenda. How are we going to organize that? Maybe 50 minutes on discussing together on these let's say 6 main changes. If you can maybe try to remain as concrete, as practical as possible, maybe with some example stories. I love stories, so don't hesitate with stories. Not too long, of course, because we want to keep 10 minutes also for a Q&A session. So also on your side, on the other side of the screen, if you have some question, feel free to prepare your question or already send them also in the Q&A, so that we can go through them at the end of that webinar. Okay, let's start maybe with that first change, and maybe the precisions on the early stage pre-revenues companies. There was a decent amount of money who flowed into that asset class over the past few years, so that also the guidelines decided to give some precisions about that. And what we noted is that, of course, it requires additional judgment because there are less measurable key performance indicators. So according to the guidelines, consideration should be given to performance, is that at above or below expectation, about cash burn, of course, market acceptance, and how close is an exit, and who would be the potential buyer, financial buyer, strategic buyer? Maybe my first question is directed to you, Elena. So for this early stage company, as we said, clearly less measurable indicators. How can you get comfortable on the fair value?
Absolutely. It's not easy, actually, because it, as you mentioned already, Antoine, it requires a lot of judgment. It's venture capital is generally a very attractive asset class currently. Like a lot of investors are interested to invest their money, but in terms of valuation, it's a big question mark how to value them and what are the main important KPIs to value this type of entities. From my experience, the most important things when you're analyzing and valuing a startup, like a venture capital, let's say, is to determine two things. One, to understand what is the stage of development of this company. Are you in the seed financing? Are you in the startup financing? Or are you in in emerging part, like when the company is starting to go more to maturity? Because depending on the stage of the development of a company, the valuation methods and the KPIs were different. Secondly, what is important to pay attention to is the structure of a capital. So is it like a capital? I mean, the company is financed only by the founders when we have a simple capital structure, or like commonly nowadays, is it in like different investment rounds financed by external investors? And these things are getting tricky. So what are the most common KPIs also suggested by IPEV, as you mentioned? It's financial metrics, we have technical metrics, and we have market metrics. In terms of financial metrics, which is pretty important, we have to assess that is it the company already in a round of having a financement, is it like generating revenues, like what are the revenues grow, like what are the potential of a company. Regarding the cash burn, like commonly in the market, we say that for a startup stage, it is important for them to have at least 6 up to 12 months of cash recovery, like in terms of revenue to recover, to have a coverage for their expenses. After this, what is important is also to pay attention if there are covenants and if they are following and respecting this covenant. This is like the most commonly practiced, but also there are different affinities. In terms of technical metrics, it depends actually on the industry of a company, like what is the startup performing, which industry, because there are different metrics which can be applied into this type of situations of a startups. And they have to understand the phase of development, if there are any cyclicity of a business and how it's evolving. For the matrix, like everything what is related to the market, we have to understand what are the potential of a company to develop. Are they addressing to a local market? Are they addressing to international market? And how they are evolving? And also the customer base. Do they already have a relationship created in place and which have to be followed? It's not always easy. Sometimes we have to determine a milestone specifically for the startup and has to be detailed and followed on each valuation event. So these are like an overall, but when you go into details, can be, it's more complicated than going in practice, let's say.
Thanks for that already, because it's already quite, let's say, a good introduction on the topic. You mentioned many different concepts, and there's one also that I noted. You mentioned that you could have let's say, a simple capital structure. Sometimes it's a bit more complicated. You have a more complex capital structure with different share classes. And in that case, and maybe in that case, I'm looking at you also, Daniele, in the guidelines, they mention also this headline value. So headline value being defined as maybe the fully diluted value of all shares times the price paid per share for a recent financing round. And of course, if you do that, if you consider the headline value, maybe you are not perfectly, fully considering the rights and preferences of the different junior share classes. Can you maybe say a few words about that, I would say, early stage valuation methodologies, and maybe in particular about this headline value?
Absolutely. Indeed, as you rightly mentioned, one of the changes of this new IPEV guideline is related to the introduction of a definition of the headline value. We all know that to value startup companies, there could be different methodologies, which also Elena covered, and they come up with an expected value for the company, which then usually is the starting point to then derive the equity value of a certain investment. But we all know that, especially in startup companies, the equity value is not just the multiplication by the price per share times the number of fully diluted shares, because there is actually a stratification, I would say, in the equity value. There are different share classes with different rights. Let's assume you have on one side a preferred dividend or liquidation preference. So those shares entitle actually the holders different rights, and they need to be priced differently. Therefore, just using the simple headline value, which is basically the price which has been observed in the latest financing round, times the fully diluted number of shares, might not necessarily be correct enough. And in certain situations, computing the fully diluted post-money equity value would require actually applying other valuation technique, which actually, via a cash waterfall would allocate the right value to the right asset class according to, basically the economic features of each instrument. That's the idea. That's why I believe, this clarification was really needed, especially in the evaluation of startup companies where the recent round of financing is usually, an important fair value evidence. Yeah.
Well, thanks for that. And indeed, this headline value is generally also something that we see at the top of the news, where we see the big
Exactly.
figure. But sometimes when we go a bit more into details, maybe situation is a bit less straightforward. In that case, and now I'm looking at you, Talat, so you have more this, let's say, auditor perspective, also as an audit partner. When we talk about the valuation of early stage companies, certainly there's more space for subjectivity here. How do you do in practice also just to be comfortable on the fair value of this investment? Can you share maybe your views on it?
Yeah, definitely, Antoine. Thank you. So I think it's important to take into account that the concept of the fair value for an early stage company is more or less the same that for a mature or developed company. And it has been mentioned, previously by yourself and by Elena as well. I mean, there is less key performance indicator. That means more judgment, meaning that, especially to follow the audit standard, it's a bit more difficult, to end up and to be comfortable with the overall valuation that basically is fed into the financial information. So what is important from an audit perspective is obviously to have the appropriate documentation around first the valuation itself, okay, either coming from a valuation or any other event. Especially if you are relying, on, for example, a recent transaction or a round of financing, obviously you need to get also the appropriate documentation around that. And also whatever specific information or data or financial metrics or key performance indicator you are using into the financial model, basically you need also to get the appropriate evidence of all those different pieces of the valuation, which is in a sense not always easy. And maybe to illustrate what I have said, we have obviously three different scenarios that we observe usually into the audit process. Either we are lucky enough and we have a round of financing that is very, very, very close to the year end, and basically we can probably rely on it, okay, considering that we have obviously external shareholders that has taken a material part of the round. Let's say in practice 5% to 10% is considered as being reasonable. And also, obviously, under a simple capital structure, that the right of the shares of the round of financing is equivalent to the right of the share of the investment portfolio company. That's something which is really important. The second scenario is that basically you had a transaction during the year, let's say 3, 4, 6 months before the measurement date. And obviously, you will use that round of financing, that transaction, as a basis point of your valuation, but you will need a valuation model in complement. And you have mentioned, I think, Elena, the milestone. That's something that we see quite often using qualitative and quantitative milestone. I think it's important to precise that the milestone needs to be set, at transaction date, And then at every single measurement date, you also assess where you are with this milestone, whether you have reached your objectives or not, and then consequently impact your valuation positively or negatively. And maybe the latest scenario, maybe the most difficult that we observe is that you don't have any specific transaction during the year, and then you need to rely on a valuation model. It really depends, you know, the maturity of the company. What we see is that still we observe a lot of milestone analysis in that regard. Obviously, as I said at the very beginning, that need to be substantiated with a quite important and good supporting information, I would say.
Yeah, I agree, and thanks for that. And you mentioned, so when you have also a recent round of financing, maybe close to the 31st of December, it would be nice. That's of course rarely the case.
Exactly.
However, sometimes we have what we call also indicative offers, and there's also a section on that in the IPEV guidelines, mentioning that indicative offers would rarely provide standalone evidence of fair value. Okay. However, a negotiated price for a transaction that has not yet closed would be adjusted for the uncertainty associated for the pending transaction. So it means that you can consider it to some extent, but not as a standalone evidence. Maybe Benjamin, so if you have an indicative offer from a third party, do you think that maybe it's sufficient for you to get a good proxy for the fair value? What would you see or do in practice?
I would tend to say, and what we see in reality is that those indicative offers can be used as an additional data point to value and to determine the fair value. But what we observe is that valuers need to be quite prudent and cautious when using those elements, and to ensure that they understand the context that surround those indicative offers. For instance, usually we will put more weight whenever we have additional offers that are part of the same auction process, for instance, that can corroborate the price that is included in this indicative offer, or whether we can ensure that the potential buyer had sufficient information to ensure that these indicative offers will not be significantly adjusted down the road because they are performing additional, I would say, due diligence exercises. So I think that it's really important that we focus on the context. And I think that what IPEV 2022 guidelines have brought as well, that is quite important, is the concept of binding offers to a certain extent, where they're saying that, I mean, binding offer by default can be seen as a contracting document, so could be seen as more relevant. But I think that based on our experience, we see that those binding offers, they still have a lot of walk-away clauses to a certain extent, subject to regulatory approval, subject to confirmatory due diligence. So we need, as valuers, we need to be quite cautious as well to look at those binding offers. And we have a concrete example here, for instance, where we had a potential buyer who placed the highest bid around on the table. And basically, to ensure that they had a sufficient IR, they decided to put a very aggressive leveraged financing structure. And as such, the local regulator decided not to accept this structuring, and therefore the deal did not close. But here, as with that example, we see that we could have focused ourselves on this binding offer, and yet was not potentially not a good representative of or indication of the fair value, because the context that we had at stake led to a non-closing of the transaction.
Okay. Thanks for that. That's also an interesting example that you shared, because also, even if we have an indicative offer, as you said, does not necessarily mean that there's going to be a deal that everything will be closed at the end. And I would say, even if this is the case, and in that case, we are back to the example that you mentioned earlier, Talat. So if we have a transaction, we have a price for a recent investment, and in that case, we should go through this calibration model, so calibrating to the price of a recent investment. And if we do that, and if we have a complex capital structure, as you mentioned it earlier also, Elena, potentially we have to adapt also the valuation techniques. And in that case, also the guidelines mentions an optional pricing model, maybe as a good one. Is that something that you see maybe more and more frequently in terms of valuation approaches to assess maybe the specificities of each share class?
Yeah, absolutely. And it's a must to do it at this stage, considering the stage of development. In practice, what happens commonly in the early stage, what we see, I mean, you'll apply, I mean, an option price model. As long as the company evolves, you move more to a probability weighted average expected return. Because in an early stage, it's more difficult to see what will be the exit strategy of a company and how, I mean, of a startup, like, and how they will see, because sometimes, I mean, most of them, they aspire to do an IPO, which has usually the highest value, but it's not always the case. So an IPO, depending on if it will be an IPO, an M&A, and the company will be privately owned, but the outcome of the exit will be different. So option price model, it's a very good mod. I mean, it's a very good valuation techniques which allows to capture these different share classes, common shares and different preferential shares, depending on the round of investment, and also to be able to allocate. So in practice, what you have to do is to estimate simple the enterprise value of a company. It can be done based on the backsolve method, like by doing or also like applying an income approach or a cost approach, depending on the situation. But backsolve method is the most common one. When I mean, you estimate the enterprise value. Next, you have to identify what are the rights of different share classes, like because they are very different depending on the round of investment and depending on how they. I mean, the equity rights. I mean, the investors will get a different risk and different return, and we have to take it into account. After the allocation, we have to see, okay, we allocated, we estimated what are the different rights, and we have to allocate this value depending on the different investment, like investor. On the other hand, when the company is evolving, we can apply, I mean, and they know already what are the probabilities of doing an exit, like an IPO or doing an M&A transaction, and they know also like what will be the scenario. I mean, let's see, the future is more previsible. In this case, you apply a probability-weighted average return, and in this case, you can you go with different fair values for different exits, and based on this, you allocate the value. So it might look complicated, but it's a must, considering that the startups, they are more risky. There are different scenarios, and this has to be captured into a valuation exercise.
Yeah, I noted indeed that. Yeah, depending on the stage of development of the company, and of course also the expected exit strategy, but sometimes the exits could be, let's say, far away. So there's also some subjectivity here. And as you said, if you have also complex capital structure, sometimes we have also to assess the fair value of each instrument. And for this one, maybe, and I'm back also to what you mentioned earlier, Benjamin, do you see in practice that the valuation analysis is always done for each class of equity, or it depends on, as Elena said earlier, depending on the stage of the development of the company?
No, I fully concur with what Elena mentioned, and another dimension that we also see as considered is whether the different equity instruments are held by the same investor or not. Obviously, if they are seen by a market participant as a whole package on equity, what we see sometimes is that they value the entire equity block as a whole and disregard the different elements that we have on an instrument level. Obviously, this means that we do not need to disclose the value or allocate the value from a financial standpoint in the reporting. But what we see in practice is that most of the time when those instruments are held by different shareholders, obviously they try to allocate the value to the different instruments. And Daniele mentioned it, Elena mentioned it. I think that here the IPEV, what they try to do is to ensure that everyone is fully aware on the liquidity preferences that are embedded in those instruments, because practically speaking, we also discuss a lot between practitioners around the valuation for the operating company, for the underlying assets. And sometimes those preferences, they can have significant impact and potentially are less monitored by the valuers. For instance, recently we had an example where we had a liquidity preference where the shares class A was getting all the proceeds of the sale because the sale of the company was below a certain quantum. And this has a tremendous impact on the valuation because it was getting all the proceeds from that sale, And sometimes we do see that I mean, in the market, there are those elements are less monitored. And I think that here, what IPEV is trying to do is to ensure that everyone, when they assess those items, they do have a deep focus on those elements.
Yeah, I noted indeed also the specificities of each class of shares. So liquidation preferences, economic rights are not the same, and also if I'm using your example, it can result in very different outcomes in terms of value. So this is something that extreme care should be brought on that. Maybe, and also in the interest of time, because things are time is flying here. I'm switching to the next topic. Also an important concept, the notion of known and knowable information at measurement date. Actually, here there are two concepts: known and knowable information, and at measurement date. And maybe for this one, Daniele, one question for you. And I'm reading here the revised version of the guidelines, saying that so known or knowable information, they are pertains to fact conditions that exist as of the measurement date, and is available to the valuer, or would reasonably be available to valuer through routine inquiry or due diligence. So maybe an easy one is maybe on the, of course, if you are back in, let's say, December 2020, also with the pandemic, would you say that the expansion of the pandemic could be reasonably available to valuer, so known or knowable information to be considered at the year end 2019?
Well, indeed, this question was probably the most frequent one, which was
yes, well, I'm asking this one.
to the valuers, no? And I believe, it's an important one. But clearly, it was not only basically COVID, raising this question. This question could be applicable to many other situations. Let's think, for example, a market which is changing, new players, new products, economical obsolescence. Those are all, items which could potentially impact the evolution of the financials of a company and therefore the valuation. I think therefore, that the valuer should focus on, his judgment and try to understand which was really the set of data available as at the valuation date. Because clearly we perform valuation most of the time on an ex post basis. No? So we are performing now many valuation as at year end. But do we really need to reflect all the information that we have as at today, as at the valuation date? And the question is maybe, because probably starting from what we observe now, we can really reasonably try to understand what was available at that time. But the valuation date is really the point in time at which a potential valuer would have considered acquiring this asset. So I believe that when we talk about this, we need to refer, for example, to the information identifiable as at the valuation date, quantifiable as at the valuation date, and also, the information which this valuer would reflect in, for example, issuing an offer to buy the investment, or on the other side, the seller potentially being willing to, sell investment at that fair value, considering those events. So again, my point is not only in relation to COVID. COVID indeed was considered, at that time, a post-valuation non-adjusting events. It was considered a little bit more in other cases where, for example, this could impact the going concern of the company. So in those cases, there was a particular, reference. But overall, I would say that should be, the framework. So identifiable, quantifiable, and with an impact on the value. And as I said, it could be COVID, but it could be other topic. Let's assume, for example, that your company has a technology which, a couple of months later is actually, no longer functional because there is a new player which has a disruptive technology. Well, not sure we should fully reflect, this element into the evaluation as at year end, unless at that date it was already known or knowable that there could be a new entrant in the market, potentially, eroding the profits. So that's important. And let me finish also with a clarification and a provocation. Clarification is it is important that at the evaluation date we look at the forward-looking information, but many times the latest available information are not necessarily referring to, I would say, a normalized situation. So who says that the latest available data are a good basis for, for drafting the future value of the company?
I think this is a very interesting point what Daniele was saying here, because when we had like the intermediate valuation in H2 like 2022, we already were saying like to the clients that look forward for the year-end valuations will go down. I mean, because the market environment was evolving very quick. So maybe IPEV also wants to highlight this point that, I mean, especially in a volatile environment, is very important, okay, to fix on the valuation date, because after the valuation date, the environment is evolving and might be in both directions, but it's important to focus on that date, not to deviate.
Oh yeah, I totally agree, and thank you both for that. And you mentioned, Daniele, also what is the set of data available, and maybe here I have also a concrete one, and maybe for this one, maybe Talat, is that if we want to do the valuation, let's say at June 30, so at the end of the second quarter, of course, you don't necessarily have the information of what will be your EBITDA, for instance, at June 30. Maybe the latest EBITDA available is maybe May, April, or even March. So, and in practice, we can see that sometimes we are one or more months in arrears in terms of earnings aggregate. As a réviseur d'entreprise, how do you see that? And is there any maximum period you would accept? Of course, I cannot take my EBITDA from last year, for instance.
Sure. Yeah, no, excellent question, Antoine. So my view first, probably as a valuer or as auditor, is that if in your example, you are basically doing a valuation at the end of June, is to have, an EBITDA at the end of June. You can take, if you have access to the information, so fine, you can take the reported EBITDA or actual EBITDA. You can basically have an adjusted EBITDA, and meaning, I mean, if you don't have the information at the end of June, maybe I'm fine taking the information at the end of March, May, or April. I don't think that there is a strict, period that you need to follow. It's a matter of professional judgment that needs to be reasonable. But I believe that this EBITDA of end of March, April, or May needs to be adjusted with what is known and knowable. That is something important. What we see as well sometimes is that for certain specific reason, because you need to issue a reporting very, very quickly after year end, you are using, let's say in that example, the end of March EBITDA. In that sense, you need to make sure that this EBITDA is maintainable, on the 12 months basis, and that you have also first a process that take into account a potential seasonality of your business, and also a strong process that basically make you sure that you identify any specific event that will impact your EBITDA and bottom line your valuation. And on top of that, maybe to conclude, I think it's also very important, whatever the information you are taking into account, that you have a strong process to assess the reliability afterwards of what you have taken as an EBITDA. Implementing, a backtesting procedure, I think is a good practice that we observe in the market to make sure that you are either not too much prudent and also not too much aggressive in your estimation, I would say.
Yeah, I agree. No, thanks for that. And maybe in the also in the interest of time, I will just switch directly to the next question for this section. So known and knowable information at measurement date. We are talking a lot about equity, but there also, of course, section on debt and private debt to be deducted to assess the equity value. And maybe on this one, Elena, we can read in the guidelines that par value or face value or even cost value is not automatically fair value. And even, I think that point is important, even if there's sufficient enterprise value to cover the liability. This wording has been added in this version. So, Elena, maybe how would you assess in that case the fair value of the debt instruments, and why maybe amortized debt is not necessarily a good proxy for fair value?
Antoine, thank you a lot for this question because it's kind of a big question mark whenever we are discussing with clients to clarify that like amortized cost is not a fair value. And this is, I mean, was already highlighted by IPEV in 2018 in the section which they have 3.8. And now what is interesting from my perspective is that by IPEV, they repeat the same paragraph from section 3.8, from the chapter 3.8 of IPEV in the chapter 5.6, I mean, highlighting once again, I mean, it's a duplication. It's very interesting for me because there are no more duplications in IPEV. Just to highlight that, I mean, amortized cost is not a fair value, but you have to focus on the yield analysis. And by yield analyzing, what does it mean? That you have there initial date, issuance date of the debt, and there is valuation date and maturity date. So these are the three important dates which have to be analyzed whenever you are doing a credit spread analysis. So for the initial date, you need to have to take the implied IRR. So practically, what is the amount of the principal, what is the maturity date, the payments, and you have to calculate an implied IRR. But following like to the next valuation event, you cannot simply amortize these because the market is changing, the borrower is, I mean, their capacity of repayment is also evolving depending on their capacity and depending on the market conditions. So you have to take into account into this and capture this into the discount rate. So you have to calibrate the initial IRR of a debt to the valuation date by taking a different credit spread and implied risk-free rate. So it's a thing which seems to be pretty simple, I will say, but in practice, like most of the clients for different reasons, for limited resources, maybe laziness, maybe it can be everything, they do not do it and still trying, I mean, to discuss this amortized cost, which is not which should not really be discussed according, because it was already mentioned in 2018 in IPEV, and now it's highlighted again in two different chapters. So it should be clear that, I mean, debt should be valued based on income approach at DCF method.
Yes, they decided to underline even a bit stronger this one, and indeed, because sometimes par value, cost value, amortized debt sometimes is considered, it's more as a proxy, but here they are also clearly saying that to assess the fair value, you should do it, as you said, also based on the yields analysis. You mentioned market conditions, and when we talk about market conditions, and that's the first time also a dedicated section on ESG and how to integrate ESG in valuation models. They make the split between also, on one side, quantitative, observable, measurable factors, and on the other side, maybe more qualitative factors, which may not be easy to quantify. And in that case, maybe, Daniele, do you see really this split already today in practice between quantitative and qualitative factors, or actually, do you see an impact from ESG factors on the valuation already?
No, that's a good question, and also this is also a recurring question. Indeed. So when it comes to ESG and valuation, we didn't really see just one factor to be applied, as a penalization or a premium on the discount rate or cash flow. But we see actually many attempts to already reflect, and I believe we are already reflecting many of the ESG related data points. I confirm that indeed we see on one side an attempt to clearly reflect this in a quantitative way, and on the other side there are still some let's say penalization which are related to the qualitative elements. But I would say that we are seeing basically two trends when it comes to ESG and valuations. The first one is clearly that players are trying to identify a framework, a common framework. And as an example, with basically with the Market and Operation Committee of the LPEA, we are trying to come up with a survey to try to understand and listen to the players how they are reflecting, this item, with a view of potentially then creating a framework itself. That's the first trend. And the second one, it's a little bit more on the quantification. Now, of course, some items may not be directly quantifiable, but just as an example, a company, for example, which has decided to be to follow a decarbonization strategy, maybe as of today they don't have in place, the assets which actually allow them to be carbon neutral. But you could, in any case, reflect this into the valuation by taking into account the future investment that the company will need to put in place. To be, for example, carbon neutral by 2050. That's just an example. Or let's assume also a company which is potentially going to receive a penalty or a sanction. Well, also in this case, you could already, in a probabilistic way, quantify the impact. So there are really different attempts, also companies which are exposed to climate risk. So there is really a strong trend to try to quantify this item. For unquantifiable items, what we usually see is a scoring model, usually based on discussions with management and potentially also with a comparison with peers, which potentially gives a premium or a penalty to the company in case the profile differs.
Yeah, yes, indeed. And maybe this framework that you described, if you are trying just to put it also, let's say, in the valuation model, also another question that we can see is also the point about, but where should it impact the valuation model? Is that more on the cash flows? Is that more on the discount rate? Maybe, Elena, any views or help on that?
I think it's already, as highlighted by Daniele, it can be a penalty or it can be a premium. So it goes two ways, but it's important not to double count it. Because ESG, it seems apparently pretty easy. Everybody talks about it, but in reality, to implement it into evaluation is not an easy exercise. And I can tell you, I participated in an academic paper to contribute, and there are a lot of opinions, but not so many facts for now. So what is important when you're applying an income approach, and normally, the ESG is integrated into the future projected cash flows. And in this case, it doesn't come as a separate line. It's commonly like this is because when ESG is implemented or nomenclated, this is the outcome of the cash flow. But assuming that the ESG is integrated in the projections, you should not really count already in the discount rate. Just to avoid like this, over giving a double premium or a double penalty.
Yes. Okay. Yeah, so here it's indeed, you can consider it depending on the information on the cash flows or on the discount rate, but just to make sure that you don't have that double counting. It should be in one place, but not in both. So that's also an important principle to respect. Thanks for that. What has been also added here, and maybe many said that is also a reason why maybe we had to wait until December to see this updated version of the guidelines, is also a point on the discount on prices quoted in an active market. So the principle is, of course, no discount, but it may be applied if there's a governmental or other legally enforceable restriction attributable to the security, not the holder. And just to explain here the difference between the two, restriction attributable to the security, for instance, is shares which are not legally registered to be traded on an exchange. It could be a good illustration. On the other side, restriction attributable to the holder is limited on trading for management, for instance, because in that case, the limitation will not pass on to the buyer of the security. There's a change here because FASB has recently modified their view to prohibit considering restriction as an attribute to the security, so that there's no discount anymore. Maybe Talat, on this one, do you see any direct impact on your client?
Yes, thank you. Potentially, yes. Basically, as you have mentioned, there were some specific updates. So in the new IPEV 2022, in that regards, in the mean that the discount which was applicable to a contractual restriction applicable to a security was removed from the RPL. And as you said, Antoine, any specific legal or government restriction is still applicable. And what we mean, by a contractual restriction applicable to a security could be, for example, an underwater lockup for a certain period. You also mentioned, correctly, that the FSAB has taken the same direction than the IPEV in removing the application of a discount for a contractual restriction applicable to a security, meaning that there is a convergence of the IPEV and the FSAB and US GAAP, US gas. However, maybe a point of attention needs to be brought, to the IFRS, because under IFRS 13, you have still the possibility, okay, to basically apply a discount if there is any specific restriction applicable to a security. And I would say that in practice, and from my experience, there were always some debates, whether such contractual restriction was applicable to an holder or to a security. But basically, if the conclusion of the assessment is that that restriction applies to the security, you might have a different treatment between IFRS and US GAAP. That's something to take into account, and maybe care should be given when you are at your level working and providing, a reporting under US GAAP. And to do so, you are basically dealing with underlying funds that are providing a reporting under IFRS. And those underlying funds are applying IFRS 13 and basically going for that discount. That means that you need to take into account that discount at your level as well. Yeah. So that's what I see in practice that might impact the valuation.
Yeah, well, thanks for the technical insight also on,
yeah.
on this one, but it's a technical point, so
exactly.
that's fair enough. Maybe another concept also that has been added here, and of course it's something that happened more frequently also during the past 4 years. It's also market dislocation. So there was also a definition for distressed or dislocated markets. So where public and private markets are dislocated or highly or excessively volatile. So as you can see here again, that there will be some subjectivity around this highly or excessively volatile. But anyway, even in such times, the premise of fair value remains the same. So the principle does not change. Maybe, Daniele, here as a valuer, what does it mean in practice, and when can we talk about a market dislocation?
Yes, indeed, as you were mentioning, this topic is started being relevant for a couple of years now. Usually, from a valuation standpoint, we define a dislocated market as a market where there is a lot of volatility, clearly, and uncertainty in relation to, potential future development. So it's a market that is altered, I would say, starting from the normal condition. And this is a situation that for the valuer is clearly, very challenging, because a lot of, professional judgment needs to be applied. I think, navigating, these times when it comes to valuation, the valuer should follow potentially, I would say, a couple of steps to make sure that the fair value is really, defendable. The first one is the definition of value. Then there are some consideration about, the performance of the target company and the selection of the valuation methodology, clearly, So on the configuration of value, already the special IPEV guidelines, which were issued during COVID, they clarify that, and this is in line with what you were saying, fair value is not a fire sale. So we need to monitor the value creation during a long run, and we do not necessarily switch from a fair value configuration to a liquidation value. So we don't have to assume that the asset is going to be sold tomorrow. And in the same rationale, IPEV guidelines were also clarifying that we would need to try to avoid this famous double dip, so penalizing the valuation twice. This is in line with what we were saying for the ESG, so cash flow and also discount rate. That's the first point. The second one is really focusing on the company and the sector. Different companies in different sectors behave in a different way under a crisis, no? So maybe just an example, we have seen increasing interest rates and inflation. How does it impact the value of an investment? Well, for example, there were some infrastructure investment for which there was fully coverage, so they were neutral to inflation, I would say, or at least they had some mechanism to recover inflation. And for them, an excessive penalization should actually not be in place. While on the other hand, if you were valuing a company during COVID and it was a restaurant chain, of course, the impact would be, stronger. So really, we need to focus on the company, the sector, and how the company is performing versus peers. And the last point is clearly always related to the selection of the appropriate valuation methodology. So if you apply a market approach, you need to be capable of understanding what's the trend and how peers are behaving into this market dislocation, because it's a relative valuation, so it's important to compare. If you apply an income approach, of course, questions is related to the scenarios, no? And what we see usually that in time of market dislocation, of course, one should focus clearly on the cash flow generation capability, but also assess which is the most applicable scenario, or at least assume that there are different scenarios with different probabilities. So I would say a lot of judgment, but valuation technique really allow to tailor the valuation also in this time of, I would say, crisis or dislocation or volatility.
Thanks for that, because indeed, where we are in such a situation, it's difficult to find objective data also just to put into the models and to come up to a reasonable assessment of the fair value. Maybe in the interest of time, maybe I will just also switch to the last section about data aggregation. So one maybe last question, because if you want to, and I can see that also some questions populating also the Q&A. So maybe one last question about data aggregation and data quality, because to be able to implement all the changes, the improvements that we discussed, of course, we need some raw materials, we need some inputs, some robust data. Maybe, Benjamin, a question for you on that one. We can see, for instance, that if we have to assess properly the enterprise value, the guidelines mention to assess a steady state working capital, to assess also the appropriate amount of excess cash, other surplus assets, maybe ESG impact, maybe liabilities outside the balance sheet. So a lot of information. How can we make sure that we have, let's say, sufficient quality and granularity in terms of data? How do you see that?
So I think that's a very interesting and complex point, because I mean, from our side, we think that this IPEV 2022 guidelines, they have brought the concept of fair value, and they've tried to align it with what we see in M&A, where, for instance, we have those kind of discussions around net working capital to adjust the price, where we would consider potential contingent liabilities, etc. So on that basis, I think that what the IPEV have tried to do was to re-emphasize the focus that valuers should have on those elements. But those elements are not new. I mean, you've mentioned the steady state of net working capital. If we take an income approach, by default, at the end of the discrete period, we should have potentially a net working capital to sales ratio that should be, to a certain extent, already reflecting a normalized level of net working capital. We have mentioned the contingent liabilities. The valuers, when they value the company, they should have access to potential incentive schemes that are presented at the level of the operating company, that are potentially not reflected for accounting purpose because they are out of the money. But as soon as we have the valuation of the enterprise value, it could be easily assessed that the plan is basically in the money and should be potentially deducted to obtain an equity value. So from what we have seen over the past 2 months is that these elements are available. What it means is that we need to spend more time to gather this information to ensure that we can answer those different points. And maybe it's really an additional layer of information that we need to gather. But what we have observed based on discussions we had with market players is that this is not something that is completely new, for which we need to invest a lot of time, because from our standpoint, this IPEV, they re-emphasize the focus on those elements, but they should have been partially or totally included already in the valuation process. It's rather ensuring that we spend the time to gather this extra data to answer those different elements to come up from the enterprise value to the equity value.
Yeah, well, thanks for that. And and I noted, so I took note. I hope that on your side of the screen also you did the same. I took note of what you said. Also, the notion of to have normalized aggregate. They are also sustainable. I think in the IPEV guidelines they mentioned maintainable also earnings. So no, thanks for that. Maybe in the interest of time, because I see it's already 1 p.m. and we had also a lot of subjects to cover. But maybe just to recap and maybe just to grab maybe 1 or 2 questions here from the audience. So we went through also the main changes. So also a focus on early stage pre-revenues companies. So further guidances on that. The notion of known and knowable information at measurement date, also an important one. ESG, of course, discount on contractual restriction, on the point here about the view from FASB, and also the notion of dislocated markets, and finally, data quality, how to make sure that we're also the right inputs to consider in our valuation models. So maybe just I'm looking at the screen also in terms of questions, and I noted and maybe that the first one that we received on option pricing model, and maybe on this one, Elena, you mentioned also you say a few words about OPM, option pricing model. So I'm reading also the question. What are the models normally used? If it is Black-Scholes model, how would you determine the volatility as model input, given the fact that maybe the underlying company is not listed and stock volatility is not observable? How would you assess maybe the volatility, which is generally a key input in an optional model?
This is a very good question, actually. And as asked already, I mean, the Black-Scholes model is the most common option price model, which we apply. We also apply binomial model, specifically to the volatility, because most of the startups or companies we value, they are privately owned. What we do, we assess a peer group and we check the volatility of the stock prices of a peer group, and we apply in the valuation. So the big question marks, which is the volatility you take. You take the volatility of 2 years, you take a volatility of 5 years, or depending on like what are the circumstances and what is the valuation plan, like, or how do you apply this Black-Scholes model to the valuation of an asset. Secondly, what is important also is to assess the duration, because the volatility and durations, they impact the most the result in an option price model. So the duration depends on like what are the exit strategies. Will they exit the investment in 1 year, in 2 years, in 6 months? Will they do? So these two, and I mean, simply volatility is assuming that it's a privately owned company, you apply the peer group, and for the duration, you look at the exit strategy.
Yeah. So indeed, maybe the 2 key inputs here, as you said, so time to maturity for the option. Or options, because maybe there could be several layers of options, and the peer group to assess the volatility, as well as maybe what's the right period for the volatility. You mentioned 2 years, 5 years, or maybe sometimes even longer. Maybe one last question, just for the pleasure, and maybe here that one is more in relation to dislocated markets. So maybe Daniele, you mentioned dislocated markets earlier. What kind of data do you use for calculation in terms of different scenarios regarding dislocated market? Because of course, if you have dislocated markets, you have no, let's say, crystal ball on what will be the outcomes of the dislocated markets. So how can you say maybe a bit more on how to assess the different scenarios for that?
Yes. Well, first of all, when we are talking about a dislocated market in the context of evaluation, we also, if it's related to a specific geography, and I see that one of the questions is integrate that, clearly we perform a deep analysis of the country risk premium where the company operates. So that's clearly an important element, which already reflects actually many of the risks that the investment is facing on one side. On the other side, when it comes to the scenarios, we usually have clearly every valuation starts with a deep discussion with management in trying to understand not only their view on the potential scenario, but how the company would behave if we, for each scenario, basically. And that's a little bit, the preparation phase for the valuation. When it comes to the identification of the scenarios, we use as much as possible external data. So I don't know, for example, growth rate from the Economist Intelligence Unit, any specific publication, because together with the definition of the scenario, we need to come up also with the probability of each scenario. So I would say how the company operates in a certain scenario is something that we assess together with management. And then for the definition of the scenario, public available sources together with, potentially some intelligence which we have collected already working in the same market. For example, in valuing an asset, I saw that there is a question on valuing an asset in Ukraine. Well, potentially in this case, we would clearly have a lot of reliance on the country risk premium, but then we would also try to assume different scenario when it comes to the end of the conflict. So management might have their views, but we could potentially shift and sensitize, the duration of the conflict, check the impact on the operation of the entity, check the impact on the clients of the entity. So those are, interesting discussion, but, the valuer needs to, the focus of the valuer is to find a coherence, between the valuation framework, which is done.
Thank you, Daniele. Thanks for that, because actually you answered two questions in one.
I know.
If I may add here, sorry, I think because what mentioned Daniel is very important, but also in the country risk premium, we also have to take into account the currency risk, because especially in dislocated markets, currency risk is becoming a big question mark. And assuming that you take a risk-free rate, which is like euro risk or so, not reflecting the local currency, you might have like not the right cost of capital in these countries, considering that the market is dislocated, the currency goes down by default, and there is a big discrepancy in between what the country risk premium is saying and the currency.
Yes, indeed, the point on the country risk premium and also the currency risk. Also, it's related also to inflation. Also, another concept important that unfortunately we do not have time to mention today. And also I can see some question on which unfortunately we'll not have time to answer, but we'll take note on this one, and let's see how also we can come back to you if you put your name also on the Zoom session. That's already a good insightful session. 60 minutes, a bit more than 60 minutes that we spent together. So first of all, thank you to all of you, Daniele, Elena, Benjamin, Talat. Thanks for that. Thanks for that exchange. I would also to thank you, EY, for welcoming us in this brand new studio, and all for the technical fix that they made. I hope that everything was fine also on your side. Thank you, the LPEA, for setting up this event, and in particular the events team. So Johan, Evie, and Joanna, thanks for your time on that. And also thank you, the LVPA, and maybe just to say, if you're also interested in more valuation-related sessions, feel free to apply also as a member, individuals or corporates at the LVPA. So membership forms are now available online. And there's a discount if you apply before the end of the end of March. So I would kindly invite you to do it. So we hope that you found this session informative and insightful. Personally, I'm really looking forward to the next one. Thanks for watching. Thanks for your time, and have a great day, everyone. Thank you.
Thank you.
Thank you.
Thank you.